All right, let's get into it. Today, we're cracking open a fascinating closed case, a brilliant and now defunct financial strategy known as the paper bond hack. It's a wild story about a ghost in the financial machine, how some very savvy investors learned to bend the rules, and, what it reveals about the incredibly complex systems that run our world.
So how did this happen? We're going to peel back the layers on a financial maneuver that took advantage of a seam in the U.S. tax code. And let's be clear, this wasn't about breaking the law. It was about finding a gap between two massive government systems that, believe it or not, just weren't talking to each other.
You see, this whole strategy existed in a space that the source dossier calls a split reality. And that's a perfect term for it. It's the gap between the rules as they're written on paper and how they actually get enforced in the real world. It was right there, in that gap, that this hack truly came to life.
And this chart illustrates the core problem perfectly, what the dossier calls statutory friction. So on one hand, you've got this old, slow, paper-based system for handling tax refunds, and on the other, a modern digital system for buying bonds. They were built for totally different eras, they didn't communicate, and that created the perfect storm for a loophole.
And the key, the one tool that unlocked this whole thing, was a seemingly harmless tax document, Form 8888. I mean, officially, it was just there to help you split your tax refund into different bank accounts. Simple, right? But it had this powerful, almost hidden function.
Okay, so here's the deal. According to the rules, the Treasury Direct website, that's the official place to buy U.S. savings bonds, strictly enforces a $10,000 annual purchase limit for electronic I-bonds. That's the hard limit for everyone. No exceptions, or so you'd think.
But here was the back door. That little Form 8888 let you use your refund to buy an extra $5,000 in old-fashioned paper bonds. The IRS would process it, and because its system wasn't talking to the Treasury system in real time, the purchase just sailed right on through.
So you do the math. For someone who knew what they were doing, the annual limit wasn't really $10,000 at all. It was $15,000. This one form could boost their I-bond buying power by a massive 50%. That's a huge difference.
And the process itself? It was almost elegant in its simplicity. First, you'd go online and max out your $10,000 electronic bond purchase. Then, you'd file your taxes, make sure you were getting a refund, and just attach Form 8888 to direct $5,000 of that refund into paper bonds. The gap between the two systems did all the heavy lifting.
The reason this all worked is what the source dossier calls the invisible mechanics. There was just no real-time data sync between the IRS and the Treasury. The systems basically took the taxpayer's word for it, relying on self-reporting with very little automated cross-checking going on behind the scenes.
But why go through all this trouble? What was the motivation? Well, the answer is all about the pressures of what's called the longevity economy. You have a growing population of retirees, many on fixed incomes, who were just desperately looking for safe ways to stop inflation from eating away at their savings.
And I-bonds were the absolute perfect tool for the job. I mean, they're literally designed to be an inflation hedge. Look at this data here for late 2025, a composite rate of over 4%. For anyone trying to preserve the value of their money, that's incredibly attractive.
And really, this was all about asset defense. The dossier hits the nail on the head here. It was a direct response to a huge threat for anyone on a fixed income where every single percentage point of inflation feels like a pay cut. This hack gave them a way to fight back.
But it wasn't just about protecting your own money. The really sophisticated folks also used this as a clever tool for tax-advantaged gifting. It became a popular way to move more wealth to younger generations, especially grandchildren, without running into gift tax limits.
Okay, but here's where it gets dangerous. This seemingly simple trick had a nasty trap hidden inside. And ironically, it was often the tax software people trusted that created the problem. The software had a critical blind spot, and it gave people a false sense of security.
So imagine you make one tiny mistake. Maybe you forgot about an electronic bond you'd already bought for a grandchild. Boom. You accidentally go over the limit. That could trigger a forensic audit, and what the dossier calls a liquidity crisis, where the very tax refund you were counting on gets frozen solid by the IRS.
Let's just walk through what the dossier calls the failure scenario. Look how quickly this can go wrong. An accidental overpurchase in April gets your return flagged by June. By July, your refund is frozen and an audit notice is in the mail, and by September, you're not enjoying your investment. You're dealing with penalties and hiring a CPA to fix the mess.
And you know the scary part is?
It didn't take much to trigger a full-blown forensic audit. Any little discrepancy on Form 8088, a mismatch in the interest income you reported, any of these red flags could put your entire return under a microscope, turning your clever strategy into a very costly nightmare.
But here's the thing. Not everyone got caught in the trap. The dossier gives us this fantastic contrast between the failure, let's call them the Johnsons, who had sloppy records, and the architect, Miss Smith, who succeeded because she used perfect execution and what they call proactive defense.
And this slide right here shows you the difference. The architect didn't treat this like some casual trick. They followed strict, serious protocols. We're talking meticulous records, getting professional guidance, and being totally transparent. That was the key to making it work.
So where does this all leave us now? Well, the party's over. As of January 1st, 2025, the government officially closed this loophole. Treasury Direct is very clear now. I-bonds are only available electronically. The paper bond backdoor has been sealed shut for good.
But the story doesn't really end there. The legacy of this hack is way bigger than just one closed loophole. As the dossier puts it, this whole thing is a perfect case study of the challenges in our complex financial systems. That split reality it exposed, that's still a really powerful force out there.
So this timeline really puts it all together. You can see the clear shift from this exploitable loophole to an official shutdown. But look at that final point. Even though the process has changed, the underlying statutes in the tax code might still be lurking in there, a ghost of the old system.
So what's the big takeaway from all this? Well, this obviously isn't a how-to guide for a hack that doesn't exist anymore. It's a powerful lesson in just how complex these systems are. It shows exactly why diligence, keeping good records, and getting professional advice are absolutely critical when you're trying to navigate the tangled rules of our financial world.
And that leaves us with one last, pretty provocative question. This particular ghost has been caught, and this loophole is closed. But when you think about the millions of lines of tax code and financial regulations out there, it makes you wonder, doesn't it? How many other split realities are still hiding in plain sight, just waiting to be discovered?